Is the summary of the Bank of Canada minutes that broke just a couple of minutes ago. Back to our market coverage. We were just talking about AT&T, which is up. Let's now talk about Rogers Communication, which is under pressure, even as revenue growth came in higher than expected. They added more new wireless customers than were expected, around 98,000. And while profit beat expectation, it was down significantly from last year as they digest the Shaw acquisition. The stock is trading around the lowest level since November, but our next guest sees 50% upside. Let's bring in Matthew Dolgin. He's senior equity analyst with Morningstar, and he joins us now. Matthew, we are seeing the stock under pressure, though, as I mentioned, the numbers basically came in at or above consensus.
Yeah, we thought it was a really good quarter for Rogers. We've been discussing how undervalued we think the company is, and our premise is based on the fact that business is going to be tough, but the market is overly discounting that. And we actually haven't seen business be as tough as we thought it would be. It's held up well across multiple metrics. So yeah, the stock is weak again. I just heard your report on the Bank of Canada minutes, and so interest rates may have a lot to do with stock weakness. There are other components also with fear of competition and regulation and migration, immigration slowing down a little bit. But again, we think these things are overly discounted in the stock, and results have held up really well. So if anything, we are more comfortable and excited about Rogers being undervalued right now rather than less so.
Yeah, do you think there's so many things to talk about with Rogers. It has growth at a time where that's difficult to find because of its acquisition, a sustainable dividend, a modest dividend yield of about 4%, and the valuation. Do you think that the interest rate environment is just the primary challenge, or is it also concerns about competition?
Yeah, we think that all things are playing into it. So I wouldn't call interest rates the primary challenge, but it's yet another thing that's putting further pressure on the stock. Yes, competition has probably been our biggest concern, but again, something that we factored in our numbers and that we have not seen be as much of a pressure so far as we thought it would be. As I mentioned, immigration is probably part of it also. But as far as competition goes, we had been thinking with the entrance of Quebecor on the national stage in wireless, on top of an already competitive environment with the big three, it would pressure revenue per user even further. That has not been the case so much. Average revenue per user in wireless for Rogers postpaid mobile phones was still above 1% this quarter, which is pretty good. They have been shifting consumers and customers to higher rate plans, so they've been doing it largely via that way. And as you mentioned, they had 98,000 postpaid net additions in wireless also this quarter, which is more than last year's first quarter and a really good result. So we haven't seen the competition so far be a weight.
Well, that's a good point, because I was going to bring it up. I've heard this point about competitive pressures. If we were to see it show up, I imagine it would be in the churn, which you referenced. That did go up a little bit, but so did average revenue per user. So right. I guess that's kind of a win there. Are those the kind of two metrics to keep an eye on in the coming quarters? Like, might that be where investors decide or not that competition is having a meaningful impact?
Certainly, we think average revenue per user is a key thing to look at. As far as churn, that has gone up across the industry, and we actually look more at net additions rather than churn. So the net additions, of course, are the gross additions reduced by the number of customers that have left, which is what the churn rate indicates. And so even if we're seeing more activity, as long as Rogers is getting more of its share and increasing the growth per user, to us, those are the biggest components. Churn had been down quite a bit in the years after the pandemic, really to artificially low levels based on history. And we've really just now gotten back to a normal level, again, with immigration being a big part of the subscriber gains recently. Those are customers that might not necessarily be able to even stay in the country on a consistent basis or be as loyal. So we take churn with a little bit of a grain of salt and look at it in the context, excuse me, of net additions.
When I look at your coverage, you're a buyer of all the telcos, BCE, TELUS, Quebecor, which have all struggled. It sounds like the thesis that you're applying to Rogers is pretty broad. You're applying it to the whole space.
Yes, that's definitely true. We think that each of the big three, so TELUS and BCE, are also undervalued, also facing some of the same pressures in their stock that we think are overly discounted. With that said, we do like Rogers the most right now. We are the most comfortable in its ability to expand profitability from here quite a bit. And in part, that's because of its merger with Shaw and the integration that is ongoing there. We also think that it's had the most success with postpaid wireless recently. And it has upside, we think, with internet and cable customers. It's struggled a bit more, whereas its peers have benefited from their fiber network buildouts. And so we see more upside rather than down from Rogers. So although, yes, we think each is undervalued, Rogers is easily our favorite.